All right, so to start out real quick, I have just a couple slides before we turn over to our presenters, but I want to share who our presenters are with us today. So we just had Ray Shea from the Phoenix Business Journal, who we partnered with to bring these workshops to you. We're going to have the following order. We're going to have Cheryl Folkerth with REDW, it's an accounting firm. Then Tim Maxey from Wells Fargo, Dom St. Angelo from Gallagher and Kennedy, Carrie Stinchcomb from Blue Cross Blue Shield of Arizona, CJ Johnson from the Small Business Development Centers, and then either myself or Angie Valenzuela from the ACA will share some last minute information that we have on a new program that's statewide for small businesses and startups. So with that, I want to do a quick introduction. For those that aren't real familiar with the Arizona Commerce Authority, we are the state's economic development organization, and we have a mission to attract, expand, and create businesses in Arizona to help grow the economy for all its citizens. So with my role in small business, I help on the creation and the expanding of small businesses to grow and create a few jobs to maybe a lot of jobs, where other parts of our organization are working to attract the TSMCs of the world, other large organizations, or help those businesses that are large that are here with some programs for expanding and growing to create additional high-paying jobs. So we reach from the very smallest of the small to the largest of the large and everywhere in between to help Arizona's business climate. So with small business services, these are just some of the programs that we have to help support. Many of you know our small business know our small business boot camp. You may have heard about this workshop through that. You probably did. We have our Arizona Innovation Challenge for tech startups. That application process is currently open. So if you've got a tech startup, you got some new technology you're developing, you'll definitely want to take a look at that piece. Of course, we have our small business checklist, our Arizona MEP. For those looking to export your goods or services, we have our export tech and AZ STEP programs. And we also have some talent training programs. So we've got a lot of stuff to help support small businesses. And today we're bringing you information from other organizations as well. And with these great presentations to help you grow your business as you look forward. So with that, we're going to jump right in and turn the time over to Cheryl with REDW and let her get started.
Morning, everybody. It's nice to see happy, smiling faces. So like he said, my name is Cheryl Folkerth. I'm with REDW. We are a CPA firm. We have offices here, Albuquerque, Oklahoma, and a small one in Las Vegas. So we do business advisory and tax audit from compliance consulting, as well as human services consulting, wealth management, business software. It sounds like a little bit like a list, right? A little bit of a laundry list. So we try to touch on many areas. The department that I'm in is called Client Advisory and Accounting Services, and I'm in charge of our Phoenix office. So what we're talking about today is why bookkeeping matters. So we're going to cover these 5 areas here, and we'll move on to the first one in more detail. So as a CPA firm, we've assisted most clients, or assisted clients through most types of financial reporting and investment transactions other than public. We don't do public. So, but let's start with the essentials, also known as the really dry stuff. Bookkeeping is the act of recording and reporting on the results of your operations. It should provide you with detailed records of your assets, liabilities, equity, revenue, expenses, and cash flows. Basic financial statements include a balance sheet, income statement, and cash flow. A balance sheet provides an overview of the company's assets, liabilities, and shareholders' equity. So the assets are what you own, liabilities are what you owe, and the equity is what you have left over. An income statement shows the amount of sales, expenses, and profit flowing through your business over a period of time. This statement is sometimes called the profit and loss statement, or P&L for short. It culminates in the bottom line, so whatever your net income is, which shows a company's profitability or net income after all costs are accounted for. A cash flow statement is a detailed measurement of cash flows and inflows to determine if a company is generating enough revenue to meet its obligations. In other words, can you cover your debts and the expenses you need to pay to generate income? So those are the essentials. If you can't record and report and see where you've been, you can't figure out where you want to go. So those are very important things. Cash flow is the #1 struggle that small business owners face on a day-to-day basis. Paying attention to the importance of bookkeeping can help mitigate that challenge by keeping close track of the cash moving in and out of your business. There are many different models for managing cash flow. When you're starting out, an Excel spreadsheet with the basics is a very good place to start. Accurate bookkeeping provides you with the information you need to plot when you need the cash, when you can expect to collect the cash, and when you need to be ready with outside sources. So having a clear picture of your cash flow management is very important. It can be done in a number of ways. Usually people start out, like I said, with an Excel spreadsheet. You get into very complicated software, starting out with a monthly budget to see if you're on track for your cash flow. Going out a quarter, even as far as a year, can be useful. Of course, the farther out you go, the less accurate you're going to be. It's important that you review the cash flow and update it as you learn more about your guesses, because basically you're guessing. You're saying customer A is going to pay on this date. Well, it might be 15 days later. So you adjust your next cash flow projection to accommodate that additional information you've learned about the process. I'm talking really fast. Like, I think I'm a little ahead of myself here. What else can I tell you about cash flow? I can't emphasize the importance of this enough, because not only should you be looking at cash flow, you should also be looking at your budget, because I think it's really important to have a budget, because if you don't say, this is where I think I want to get to, and compare your actual results, you're not learning about your business, you're not finding different ways to grow your business. So I think it's really important to go through that exercise. So now that you have complete and accurate results from your bookkeeping, it really smooths the way for preparing your tax returns, which are mandatory. This includes tax reporting, not only income tax reporting, but compliance reporting a business is required to complete. For example, sales and use tax, payroll reporting. As we all know, everyone who could took advantage of the PPP loans. That took a certain amount of specific reporting in order to get those forgivenesses, and some corporation reporting. Accurate records support better, faster tax preparation. So the cleaner your books are, the less you'll pay for tax preparation, because you won't have to have them fix your books and records. And the cleaner your books are and the more up to date they are, that gives you more opportunities for planning purposes. So if you're scrambling at the end of the year to get things together, you wouldn't have had a chance to discuss, this happened this year. Should we talk about R&D credits? Or this happened, can we qualify for the employee retention credits? There's all kinds of opportunities you can have if your books are up to date and you share them with your accountant. And further, when you're working with investors, one of the first places they look is at your tax return and compare that to your accounting. So if your tax return and your accounting are significantly different, that's going to cause you issues. So you want to be sure that those two things are in sync. Do not expect yourself to be an accountant. There's a reason why people like me spend years and years learning how to do it. You should be working on your business, not in your business. This is one of those areas that's a good idea to outsource these kind of services so that you don't have to spend your time chasing that invoice or this debit or that credit. Have somebody else do that work for you. It can be done internally with assistance from your accountant or your outside CPA or whoever, but try to offload that process to somebody else. You're good at what you do. You need to follow your passion for your whatever business you're in, because usually you start with a will. I'm always impressed with entrepreneurs because they start with a will to do something, create something out of nothing. And I'm always impressed with that. So what our job is to help you get where you want to go. Okay. Something's not working here. There we go. Okay, so business analysis is the next step. So you've got your essentials, you've got good books, you've got cash flow, your tax preparation is under control. So the next thing is to analyze your books and records and use the information from your cash flow and even from your tax preparation to help you make decisions about what you should do next, where you should emphasize next. There's lots of different ways to do that analysis. One of the ways that is a buzzword now is key performance indicator or index. There's lots of different kinds of key KPIs. We have clients in all ranges of businesses. So we have different KPIs we monitor for. We have a golf course. So we look at rounds played and how many carts they rented and how much beer got drank in the cart or at the restaurant, all those kinds of things. But if you're a different kind of business, you don't necessarily need that kind of KPI. So one of the ones that I did a quick search before I came over. It's like, if I wanted to see the 5 top KPIs, and there's 15 different opinions about that, but here's a good one, a good list of 5. Revenue growth, revenue per client, your profit margin, and that can be based on cost of goods sold, which would be product, or if you're a construction company, what the profit margin is on your jobs. Client retention rate, which is a key thing for us. We look at our client retention rate and customer satisfaction. Another KPI that we look at in this day and time is employee retention rate. Are employees satisfied? What else can we do to make them happy, satisfied, want to stick around and grow in our business? A lot of software has these kinds of KPIs built into them today. There's all kinds of systems out there that help you do these kinds of calculations and help you do the basics and the cash flow, not the tax preparation, that's different, but the business analysis can be done with built-in software, anything from QuickBooks Online to Sage Intacct, and then there's all kinds of other software that will help you take the transactional piece of your business and automate it. Because if you don't want to be doing manual input, and neither do the staff that work for you. So things like bookkeeping or Bill.com or Expensify. Fathom is another one that we use that works really well for consolidating companies. If you have a number of different businesses or business lines, you can look at consolidating those in Fathom and putting different KPIs on those to see how the results are working or how you expected them to work. And you can do some benchmarking, which is another way of saying, compare yourself to other businesses that are out there. Somebody in a similar business line for you, do they have a gross profit of 75% and you have 50? Well, why is that? What are they doing differently than what you're doing? So what I would recommend, in addition to having a strong relationship with your accounting team, whether it be a CPA or bookkeeping service or tax preparation firm, whatever that looks like, I would also look to make sure you have the rest of your board kind of put together. So you have good advisors to help you when you have to make a decision. You know, you should have a relationship with them before you need them. So a good attorney for different kinds of matters, corporate attorney, depending upon the business that you're in, you might need a bonding agent. You know, have those relationships before you need them. A good insurance agent that can help with whatever insurance you need. You have, you know, cyber insurance. We recently had a situation where our cyber insurance used to provide unlimited coverage for a certain area. We have had to change our processes and procedures because they're starting to limit that cyber support. So I feel like I'm forgetting something. Attorney, insurance, CPAs, doctors. No, that's not the right one. Oh, a banker. I'm sorry. Sorry, Wells Fargo. Bankers, having a good relationship with a banker, maybe more than one relationship, you know, depending on what kind of financing you need and what your goals are. If you have multiple locations, not every bank allows you to bank in multiple states. So you need to look at those kind of relationships too. So the 5 things I think you should do immediately, whatever the stage of the business life cycle your business is at, do the essentials: record, report, and budget. Manage and plan for cash flow. Smooth tax preparation and increase tax planning opportunities. Improve decision-making and planning, and build a team. These are not super technical things. These are not difficult things to do, but it behooves you to get in front of this, especially if you're a startup and you don't know people. Ask your friends. Who's your favorite attorney? Who's your favorite insurance agent? Ask your other professional providers. So your business needs accurate bookkeeping for growth and maintenance. Make sure you're considering these points so you're ready before the day comes when you need them. It should be a practice you do every month. Does anybody have any questions?
If you have a question in front of you or on your table, there's a microphone. Click the button so it turns green. And that way the online group can hear you as well.
Can you hear me? Okay. What do you think is the #1 mistake that small business owners are making that is like, that you see a lot and that you help them with?
Well, I would say not having a professional help them with their accounting. You know, if they don't do that up front and get a good start, then what happens is they come and say, it's broken, can you fix it? And it ends up costing them 3 times as much as if they spend a little bit up front, talked about where they want to go, set up their chart of accounts, you know, even as basic as their chart of accounts in a way that's meaningful and gives them the information that they need, and also allows, you know, tax preparation to happen and whatever else they need to have happen. It's much better to start off that way and do it professionally. They think it's like accounting is not hard, and it's not rocket science, but it's not something you can do without having knowledge. Mm-hmm.
Any other questions for our accounting experts? Faith, do we have any online? We've got one right here at this table.
Good morning.
Morning.
So I'm feeling like one of my biggest challenges is cash flow.
Yes.
So working with the bookkeeper, what is that relationship like? Is the bookkeeper kind of helping you really see what the cash flow is? I don't know. I just kind of wonder like how that cash flow conversation happens with the bookkeeper.
Yes, well, that is, you know, sometimes a bookkeeper can't do that because they don't have the skill. But you got to start there. You got to have good bookkeeping records in order to do the cash flow. So if they're not the right person and they don't know how to do it and they're not being helpful, then you can look for another professional to help you with that. But you have to be able to explain what you need. So you're saying, here's my accounts receivable. We need to plot when this is going to come in so that I know when I'm going to need money to meet payroll or whatever it is. And then you want to plot when your payables are due. It's really just an exercise in going collect, pay, collect, pay. And it's just kind of plotting that out in the best way that you can, just so you're not caught short. Like I said, it's not rocket science, but you kind of have to have a system and a rhythm and know what it is you're looking to have happen.
Good morning. My name is Cassandra. My question would be, my husband started a small business on his own. He's been doing it for about a year now.
Okay.
And I am a stay-at-home mom. And so recently he went with all his piles of papers and says, here, take over. I want you to do all the office stuff. And so I can honestly say I'm lost. You know,
Yes.
I'm basically just going off of what I believe I should be doing. And so this is a start for me, coming to these classes to learn how to run my office or his office, you know, but now, you know, it's a husband and wife thing where it has become my office. And so my question would be, what do I even look for in a bookkeeper? Where would I start to begin to look for a bookkeeper, you know, a CPA, you know, where would I find a good CPA? There's so many things. And I could say I'm probably one of those ones where you said tax preparation, and right now I'm so lost. You know, we're supposed to be doing quarterly. He hasn't done anything. And so I know that it's just, wow, I just got into a big mess.
There's all kinds of different ways to find an accountant or a bookkeeper or a CPA. You know, most of the time you're going to start with your friends. Who do you know who knows somebody? So you start with that. Like, I'm looking for help in this area. There are a lot of things you can learn online. You know, for a small business like yours, QuickBooks Online is a good place to start because it doesn't live in language that's accounting only. It communicates to you with language that you're going to understand, but you still have to know accounting to be able to do it. I see that all the time. There's all kinds of resources on site. Does the ACA have recommendations for
What we
bookkeeping?
generally do is tell them to go to the Professional Accounting Association. You know.
Okay, so the state society.
Yeah, and ask there who they may have locally at the different levels. You know, we have partners like REDW. We've done stuff with Beach Fleischman in our boot camps. They're a large accounting organization.
Right.
You know, there's those large accounting groups, but there's also a lot of local accountants. But I like the idea of asking your friends, other business owners you may know, who are you using? I do want to say thank you. That's the first step, is getting involved, saying, hey, recognizing I need to understand more and coming to workshops and doing that. Another organization you'll hear from later today is a Small Business Development Centers. You could ask them they'll usually give you 3 or 4 recommendations for bookkeepers or accountants. They work with some as well. So there's resources to help you get started and find those answers.
Thank you. And I'm happy to talk with you further. If you'd like to talk to me afterwards, I'm happy to talk to you, just to kind of give you some additional ideas.
Thank you.
You're welcome.
We do have one question online.
Okay.
Would you be willing to share a case study example of the role of the bookkeeper in helping with cash flow management?
Case study example. Well, I can only speak to what we do. So we have a number of clients we do the cash flow projections for. So the first step, of course, is having the books and records done the way that they need to be done. And then we usually meet with the client to find out what their needs are. So what is it you want to know? Do you want to go 6 weeks, 13 weeks, further out than that? And then we come up with a format that is easily understood by everyone so that you can look at it and go, oh, I understand what this means, or I know where these numbers are coming from. So it's a process of working together to get the results that you need. So you can see where the holes are, where you're going to need that money for payroll or big loan payment, or you want to buy equipment. So you figure out how you can get to the point where you can buy that equipment. Did I get a good answer for you?
Yeah, I want to add to that because that was perfect lead in and that's the whole point of this workshop. And the kind of flow we have is the accountant or your bookkeeper can help you identify your plan, hopefully your business plan, and look at it and be like, okay, here's where you're gonna need to go, here's the cash you're gonna need. When you talk about case studies, I've seen a number of companies with a previous organization I worked with. I talked to franchise owners that made this mistake, is they'll use all their cash and then they'll go, hey banker, I need some money. And the banker goes, you don't have the cash that you need because they already spent it. So having that plan on the front side, working your accountant is gonna, and when Wells Fargo talks, are gonna mention this, is you wanna ask for that loan before you need it, because you're gonna need that other cash that you have for other things. If you go drop it into an expensive machine, you may not have it for payroll and other things. And if you didn't already get that line of credit or debt or whatever, it's harder to get at that point. So having that business case scenario is start with your bookkeeper, start with your accountant, make sure you understand here's the upcoming expenses, or I need to grow. I'm at that stage of growth. Here's what we're looking at. What's it going to cost? I have some cash that could do it. But if you spend all your cash there and then a pandemic hits, then what are you going to do? So we get the loan on the front side, et cetera. So that's perfect tie-in to this workshop and our next presenter.
Our next. Yes,
Hello, good morning.
good morning.
I have a question about tax preparation. Can you recommend any online resources or checklists for folks who are trying to get all their tax prep done?
Well, an online checklist, that's a really good question. Could I send something to Robert and you can disseminate it? Would that be all right? Yes, I have some, but I do not have the website in my head. I'm sorry. Yes.
Yeah, we'll add that to the materials that will be on the website for this workshop, because we're going to post all the presentations as well, so you can access the presentations and see them. So we'll post some of that other material.
So
With some of that tax preparation or talking about tax stuff, is we had a workshop in the spring with the Arizona Department of Revenue. And they shared some stuff. So for those that are scrambling because they didn't do their quarterly taxes and they're trying to play catch up, they have some hotlines to keep you out of trouble. Might still have to pay some fees, but they have some things that are out there to help people get on track.
The one thing I would say is if you are not a new business and you had a tax return done last year, make sure the balances are the same as what you reported last year. If you change things that happened in a month or a year that's already been filed, that just causes havoc. So try not to delete things or avoid them in a prior year. Any other questions?
The information you, or the seminar, whatever y'all have on tax revenue, with the tax revenue?
Yes,
Is that on your site?
it is. It's in the content library and the Small Business Bootcamp webpage. All right.
Okay.
More questions?
All right.
Thank you,
Thank you
Cheryl.
very much.
All right. I want to thank REDW for their time today for that presentation. Now I'll turn the time over to Tim Maxey from Wells Fargo. Forward back.
All right. Well, good morning, everybody. So Tim Maxey from Wells Fargo. I'm the lead business growth strategy consultant. Today we'll talk about managing business credit. Like Robert mentioned, we'll talk also how do you interact with the bank? How do you build that relationship, and how can you work with your banker to get access to capital? So a little bit about me. I've been in banking for 17 years now. Throughout the country, I've worked North Carolina, New Mexico, Arizona, California. So all over the place, a lot of moving, no more moving. I'm done. We're staying here in Arizona. Live here over the last few years with my wife and our 4 kids. My wife is a small business owner here in Arizona, and that's my passion. I absolutely love small business. I love working with small business. We talk strategy. My primary role is coaching. And so I do a lot of coaching on how do we help small business owners in the bank. So I'll provide some of my insights from my career and my experience on what I've seen that works and what doesn't work when you're interacting with your banker. So a couple of topics that we're going to look at today is managing credit, What lenders like Wells Fargo are going to be looking for. We're going to look at the business credit life cycle and some financing options that most banks offer. And then I'll give you some resources at the end. All right, so credit is something you want to think about as a resource. So you want to think about, how do I manage my credit actively? A lot of times we do see customers come in and they have no idea. They don't know where their score is, or they'll tell us, oh, my score is incredible. It's a 780, and we pull it up and it's 500s. Or I've seen it the other way too. They're like, I have terrible credit, and we pull it up and it's 780. So it's important that you actually know what is your credit score and what does that mean? What's on your credit? You can get credit reports free every year. So I would recommend go to one of the credit reporting agencies, take a look at that. How can your business rely on credit? It helps you provide working capital. So you can get lending, line of credits, credit cards, commercial loan, equity loan. There's so many different options out there to provide working capital for your business. It can help support business growth. So if you do have that line of credit and a big opportunity comes around, you have money that you can use right away. To what Robert mentioned too, is if you go into the bank at that moment and say, hey, I need $100,000, but you just spent all your cash and your capital is it's zero at the moment, it's going to be hard to get that. So you really want to be thinking about, how do I get access to capital early? So be talking to your banker about that, and we'll talk more. Take advantage of opportunities. So like I said, if you have that big business opportunity come up, you can use credit for that. How can your banker help? So your banker should be conducting business financial reviews with you. I would recommend, if you don't have a relationship with your banker, start that now. Find out who your banker is. Most businesses are going to be assigned to a business specialist or business banker, somebody within the bank, and you want to know, who is that person and how can they help you? So if you don't know that, contact your bank and find out who it is. Start working with them now. Review your business situation with them. We had a question over here, is how could I get help on cash flow? Like, I can get the information from an accountant, but what do I do with that? You can take that to your banker, to your business banker, and say, here's the data. Can you help me understand what's going on? And that's what we're trained to do, is look at what's the money coming in, what's the money going out? How can we help you make sense of that? And how can we help you use that? And then discussing your future business goals. Super important that you share what you want to accomplish in your business. So what is your goal for the next year? What are some of those major purchase or major things that are coming up that are super important to you that we could help out? Where do you see your business in the next 5 years? Do you want to expand? Do you want additional locations? Are you going to go outside of state lines? So tell your banker that, and we can start looking at where you're at currently and what steps we can do to help you get there. When you meet with your banker and you're sharing all this stuff too, ask them about capital. It is so important that you get it now. And when we go through the 5 C's of credit here in a minute, I'll talk more about that. But it really does help, even if you can just get a small credit line now, or even a credit card now. You want to start building that credit for your business. So be thinking about that too when you meet with your banker. So you want to take control of your credit profile. This is everything that the banker sees about you. When we pull up your credit, we get a lot of information on there. So a couple things that you want to think about first is having checking savings accounts for your business. Separate that from personal. We are going to look at what is your business relationship, what is your personal relationship. If you have those intermingled, it's tough for us to determine what's going on. A lot of business owners do that, especially starting out. They're injecting their own personal cash. They might be using a personal credit card, and that makes sense. But over time, you definitely want to start separating that out. Have a business account, have a personal account. Make sure you keep a strong payment history. We're looking at that specifically on your credit report. We'll look at that on the business side and on the personal side. So keep your payment history good. Review your personal credit profile yearly. I mentioned that earlier. You can get that free credit report. Clear up any issues. Some of those things stay with you for a little bit, but if you clear them up, your credit score will dramatically increase. Bank strategically, consolidate banking relationships. It may make sense to not have 5 or 6 different banks. If you're a bigger, more complex business, maybe you want to have strategically a couple different ones, but it can make it very confusing when we're trying to look at finances and your accounts are all over the place. So think about your banking relationships, where you bank. Are you too spread out? Look at your relationship with the bank. That does matter. So when we look at lending you money, we are going to see, how long have you banked with us? What does your accounts look like? Do you have money in the accounts? Is there capital already in there? So is there cash in your accounts? Have you overdrafted your account a lot? That's something that we'll take a look at. Has there been bad checks written off of there? So there is, it's very important to make sure that you foster that relationship. And again, it goes back to, do you know your banker? Have you had a conversation with your banker? And do they know and understand your business and what's important to you? Demonstrate a consistent flow of funds. So you heard from Cheryl earlier about the importance of bookkeeping and having that cash flow statement. So you want to make sure that you have those. That is very, very important. And you can bring that to the bank and let us know the financials of your business. And again, cultivate your relationship with your banker. Be clear about your situation and your goals. All right, so we're going to look at both business and personal credit history when you're working with your banker. I would say the majority, if not all of banks do this. So if you apply for a business loan, business line of credit within the bank, we're going to pull your personal credit as well. We typically will require a guarantor for that credit. So it's important that you look at both. We're looking at your credit reports. We're looking at payment history, credit usage, debt load. You don't want to have too much debt out there, but you do need to have debt. So it's important. That's how you build up your credit. You do have to have some sort of lending out there. You have to be paying those on time and regularly. We'll look at how long your credit's been established too. This is one of the basics that we teach all of our bankers, is the 5 C's of credit. And it's surprising how many people don't know this too. And a lot of business owners that we see don't really understand the 5 C's of credit. We know that there's a credit score out there. 99% of people have no idea how we come about that or how the credit agencies come about that score. It's a mystery, but it's important. We'll go through the 5 C's real quick. So credit history, this is how you've handled your past credit obligations. This could let us know what we can expect in the future. Typically, this is your credit score. So this is, I've taught this in schools to middle schoolers, and we do the example of, if I lend you $100 and you don't pay me back, do you think I'll lend you another $100? Or we might flip that around, and you lend me $100 and I don't pay you back, and then come back and say, hey, can I get another $100? And the kid every time is like, nah, not paying you back. So same thing. We want to see, are you paying back your obligations? Collateral, this is a big one too. What are you going to use the money for? Is there property that you're buying? Do you have a big piece of equipment? Banks can get pretty creative with this too. If, I think of a restaurant that we helped not too long ago that was having some cash flow issues. They actually had a walk-in freezer, and those walk-in freezers are worth a lot of money. So we were able to use that as collateral for a loan. So be thinking about what property, what assets do I have that could be used? You typically get a better rate on something like that. Capital, Robert mentioned this earlier. It's sometimes too late once you come into the bank and say, I need access to capital. I need money. I got this big thing coming up. I need $100,000. I already had to use all of my cash. I'm kind of in a pinch right now. It gets very hard to get an approval if you don't currently have some capital. So we want to see, do you have a personal investment in the business? Do you have any assets that you could quickly turn into cash? It goes to your ability to repay. So be thinking about that. You don't always want to use your cash. Cash is great to have. There's situations that make sense where you use your cash, but If you're needing a line of credit, if you're needing lending, we're absolutely going to look at that. Conditions, this is always the fun one to talk about. These are some of those internal, external factors. COVID was the big one that comes up all the time right now over the last few years. That's been a pretty big condition that's affected a lot. We're in a rising interest rate environment. There's supply chain issues out there right now. Cost of everything is going up, it seems, right? Potential recession, there's arguments, are we already in it or are we approaching it? And how is that impacting your industry? That would be something great to talk to with your banker. So what are some of those conditions that you're afraid of right now? Is there something in your industry that you're saying, hey, cost of cement has skyrocketed and that is killing us right now, or cost of my supplies? My brother owns a cleaning company, and a couple years ago, he supplies all the toilet paper for his offices that he has, and that was a huge one. So he's calling me like, what do I do? There's no toilet paper anywhere. So that's a condition that could affect your business. And capacity, we're going to look at cash flow. We're going to look at how much money are you making? What's your revenue? Do you have the ability to pay what you're asking for? So what we're looking for, we do want to know the credit purpose. It is surprising how many people come in to say, I want money, and we ask why, and they're like, it's not your business. We just want money. But that is our business. We do need to know. It does help us make the right decision and make the help you with the right choice for lending. So the credit purpose is very important. So be upfront with your banker. Tell them why you need it and how it's going to help your business. You can share your business plan. A lot of times that's in the business plan. Credit history, again, we're looking at that. We want to make sure that there's no surprises. We see a lot of times that, I mentioned earlier, they either don't know where their credit is, or I worked with a customer yesterday, a banker and a customer, where the customer is saying, hey, my credit is completely clean. And we found out it's like, well, except for those last year where we had a bunch of issues. So be upfront and tell your banker if there's going to be a surprise, it's okay. We might be able to work with it. But if you had a bankruptcy 5 years ago, it's okay. You can tell us, and that'll just help us as we move forward. Company finances, provide cash flow projections, demonstrate your ability to repay. This is why what Cheryl shared earlier is so important. You have to demonstrate that to the bank. So you need to be able to come with your financials on the personal and business side and show us what's going on with your business, and we will use that to see if we can approve the loan. I think I shared in the last time I presented, one of my favorites was a customer that came in with just a yellow sheet of paper that he ripped out of a binder, and he had written some cash flow stuff on there. And we had a fun conversation on that one. So I would recommend more professional software or have an accountant. That is important. And then application details. If we're providing something for an application or we need paperwork for you, just make sure it's accurate, filled out neatly. The quicker you get it back, the quicker we can move forward. The better we can understand it, the quicker we can move forward with you too. When you think about cash flow, how do you take a look at this? How do you really assess your cash flow? You want to accelerate your inflows. How quickly is money coming in? Are invoices being processed quickly? Do you have invoices that are sitting out there for a while? How do you make sure your customers pay you quickly? What are your payment options? Are you primarily just checks? Do you take credit card, debit card? Are you doing wire transfers? So how's the money coming in, and do you need to expand that? Could that possibly help? Monitor your costs. Tracking bills, inventory, know your payroll obligations. Again, this goes back to the previous presentation. You have to have that data to be able to assess it. So you want to be looking at what's going on with my inventory. Is it sitting there for a while? Am I moving inventory? If not, how do I do that? Is payroll killing me every month that I'm just kind of crossing my fingers that the money will be there when people go to the bank? So if that's an issue or you're concerned about either of those, again, talk to your banker. We would be happy to look at that and look at some of the details that you have and assess how do we make that a little bit quicker. Watch your outflows. You can manage it with credit. There is times maybe you have a seasonal business and you need to use a line of credit card to help with your cash flow. That's what it's there for. Take advantage of trade discounts or barter arrangements. So if you have a line of credit and one of your suppliers says, hey, if you pay this within 10 days, we're going to give you a 2%, 3% discount. Use your line of credit, pay it. When the cash flow comes in, pay it off. There's typically a grace period where you don't have to pay interest. That could get you that extra 2 to 5% if there's a trade discount out there. Cover your taxes. You want to make sure money is set aside for taxes. That is very, very important. Pay your taxes, have the money set aside. We always recommend if you could do like a separate savings account, just throw some money every month into that. So, you know, every quarter you got some money set aside. And then challenge everything. Make sure relationships with your business, you're getting value from them. Is there a way to cut expenses? Is there a way to increase some inflows? Business life cycle. So 5 different stages of the life cycle, and there's different lending for each stage. I'll just go through this really quick. For a seed or startup, a lot of times you see this is where you're injecting personal cash. You're using money from family. You might use personal credit cards. You also want to be talking right away. As soon as you start the business, could I get a business credit card? Could I get a business line of credit? Is there financing from the bank? And a lot of people think that, oh, it's a new business, I can't get financing. Most banks will offer it. It is okay. So I know at Wells Fargo, we do offer financing within the first 2 years of business. So it is possible to do that. Once you hit the growth phase, you might be looking at, how do I move my company forward? I'm starting to grow. What do I do? This is where a business line of credit is huge. You may want to look at some of the SBA loans, 7A and 504. You may want to look at refinancing or maybe even purchasing commercial real estate at this point. It's possible if you got commercial real estate early that you have some equity that you want to take a look at here. There's also some healthcare financing options. Once you start hitting that maturity phase, you want to think about, how do I pay down debt? How do I refinance? Am I really getting the best rate on the commercial real estate? Do I have a lot of equity built up right now? And if so, what could I do with that equity? We move into expansion, and you might need additional commercial real estate, depending on number of locations that you're going to have. This is where, again, you can look at SBA loans, healthcare financing options, maybe additional line of credit. And then there's that point where you start thinking about transitioning your business. Are you retiring? Are you going to sell the business? Are you just shutting down? You want to think about, did I pay down debt? Can I pay it down as much as possible? Refinancing any real estate, seeing where I'm at with my debts. You want to make, if you are going to be selling your business, how marketable is this business to sell? Financing options, 2 of the most basic: secured, unsecured. Secured means that you have some collateral that you're going to use, and typically we give better rates on that. Unsecured is what we typically would have called like a signature loan that you just come in and sign for it. We give you money, typically higher interest rates. Some of the options: credit cards, these are your everyday needs. Lines of credit, this is a little bit larger revolving source of funds. Commercial real estate, this is when you're buying property. SBA loans and lines, some of the government guaranteed lending that we have, and then healthcare financing. There is specific financing for healthcare field as well. And then some other creative ways for funding. You might be able to do some seller financing if you need to buy a big piece of equipment. A lot of times they offer like 0% for a certain amount of time. You could do factoring, peer-to-peer lending, mission-based lenders. We have a list of CDFIs through Wells Fargo. I think some others in here have a list that they can do as well. And then community development grants. So be thinking of other ways that you could get capital. And some free resources. So if you go to wellsfargo.com and wellsfargo.com/business, I should say, and just look at business resources, there's a ton of stuff on there. So I would encourage you to take a look at that. If you have questions for me, feel free to, and outside of right now, feel free to email me. It's tim.maxey@wellsfargo.com. So tim.maxey@wellsfargo.com, or look me up on LinkedIn. You can connect there and ask me questions there too. So, any questions?
All right, any questions for Tim? And also online, if you have questions, put those in there.
Hi, can you hear me? Yep. I have a question. So we're a fairly new candle manufacturer, about 2 years old. We jumped in it the day after COVID shut everything down. There was no plan at all. I have a business partner and we're 50-50 ownership. Our problem comes from, obviously we started with a lot of credit cards, my credit cards. I have really good credit history. She does not. So then when we went to my bank that I have my mortgage with, all my stuff is good. We can't get a business line of credit because of her credit. Is there other options? And, you know, I couldn't even do it like all on my own because she owns 50%. So what are some other options?
Yeah, so that can be a tough one. We see that a lot where one business owner's credit is pretty solid. The other one, there's some challenges. Easiest way is talk with the banker and find out what specifically were the issues, which they might have shared, and then start thinking about how do I overcome those? How quickly could that happen? So a lot of times you pay some stuff down, you catch up maybe something that was in collections, you're gonna see your credit score jump up, and that might be the small difference that you need to move towards an approval. The next one is if they can't do that and they're saying, yeah, we'll make a plan with you, but we're probably looking a year or two out. You may want to look at some of these CDFIs. We offer them through Wells Fargo. I could give you a link. I think others in the room may have some too. I think ACA has that, and they can direct you to some of these mission-based lenders that will help you get access to capital when a bank can't approve you.
Okay.
So that's another good one. The third one, which is more of the extreme one that might be tougher, is looking at the business ownership and see, you know, what can you do there? So, but yeah,
Okay,
that's a little
thank
tougher.
you.
So, yeah.
I have two questions. What would you say would be the ideal like debt to income ratio for a business?
This one gets asked every time, I think, too, and this is a common question. Typically, you want to make sure it's under 40%. If it goes over that, sometimes we can get approvals. I can't say it's like, oh, you're at 41%, we're saying no. But if you're over 40%, it's harder to approve. Under 40% better. Way under 40%, even better.
All right, part two. You said that people need a credit purpose, right? You can't just come in and say, hey, I need some money. But you also said that it's good to get money when you don't need it. So say I have money in the bank, but I'm like, okay, I'm trying to plan for a rainy day and I want a line of credit, but there's nothing specific I want it for right now. How does that go?
Perfectly acceptable to say that. Just tell your banker, I need money just in case. I need cash reserves is what we would call it. So that's something that your banker is, completely good with, that you need cash reserves for a rainy day. You want to grow the business one day. You just want something for an emergency. To us, that's super smart to do. And we love lending for those purposes.
Would that be like a time-based product? Like you have to use it within 5 years or 10 years, or is it just open-ended generally?
Yeah, great question. Lines of credit that we offer typically are time-based. A brand new one, if you've been in business less than 2 years, we're typically going to do about 5 years on that. At the end of 5 years, that would close out. You'd have to find different access to capital. If you've been outside of 2 years in business, we can do 10-year access to that line, which 8-9 years, we're going to start talking to you about re-upping that to see if you want to extend it, increase it, that sort of thing. Yeah, absolutely.
Tim, on that line of credit, do you have to level it out, pay it off within each year, have it down to zero, or can you maintain a balance of debt on there?
The majority, you don't have to. So the majority of business lines of credit that we offer, you can just keep a running balance on that. As long as you're paying as agreed, you're good. There is some, once we get into the higher commercial lines of credit, they may require that you pay it down to a certain point throughout the year. It's possible at some point on some of those, you might get a balloon payment at some point too that you need to pay.
And then for a smaller new business, let's say they're starting out, they go get their bank account, they get a business credit card or a small line of credit. is it beneficial for them to, even if they have the cash, to use the credit and then pay it off, and then use the credit, and then pay it off?
Yeah, great question. Yes, you want to show that you're using your credit, that you've been able to have a balance, that you've been paying it off. So you're accessing that. There's also strategically for your business is potentially huge, that if there's rewards on your credit card and you're going to be buying stuff anyways, you got to buy supplies, might as well put it on your credit card, get that 3-4% cash back, pay it off in 28 days. You're not going to be paying the interest on it, and you just gave yourself a little bit more cash flow. So we have customers that are just making thousands of dollars a year in rewards, and it's just a smart decision. Plus, it's helping your credit and makes your credit look great.
So with the line of credit, I know you said you look to see how much we have in our account. I know we start off right, we do have a separate business account for our personal accounts. But unfortunately, we go through all of it, every single last penny, buying materials, buying supplies. We own a plumbing business, and so all the time we're running out to the supplies that are all of a sudden we haven't been able to have enough cash flow to have a stock that always have something. No matter what, we always have to run out and get something. And so that's something that I think there's a line of credit. How would that work? We are with Wells Fargo. Just to throw that out there. So my major, I can say we've been with you guys for 2 years, and I do not want to know that I have a personal thing. I'm glad to know that you want to go home and find that out. But will that hurt us? That if you guys look into our business accounts, that we've got the money there, we have enough to run our business, keep us afloat. But I don't know if that's going to hurt us looking for our business line of credit.
Yeah, great question. Thank you for your business. We appreciate it first. And definitely find out who the banker is. Reach out to whatever branch you typically go to. They can talk through those issues with you too. That's one part of what we'll look at for the line of credit. We're going to look at the banking relationship. We'll look at the cash flow, how your accounts are looking, how long you've banked with us is important. If there's any issues, we'll look at the personal side as well. So that's just one portion. We're going to look at the credit. We're going to look at finances as well. But bring all that to your banker and then just take a look at what's going on in the account. If you feel like, man, it's tight every single month, they might have some ideas that can help you. Maybe lending is the right thing, or maybe they can just make a plan and just say, what if we tried this? Maybe that will help increase some of the cash flow that you're seeing and might help you out. So just let them know what you're experiencing, what your goals are, and they'd be happy to look at that with you. Yeah.
We do have a question online. For people who offer online services like coaching or workshop development services, what types of projects do you typically fund?
So you're saying online only, so online coaching, is that what I heard? Yeah, that one, it depends on what you're needing. So I would go back to that. Like, what do you need the funds for? Are you needing it to fund additional equipment? Yeah, I would say there'd probably be more questions I'd have about what you need. If you're just needing it for cash flow, cash reserves, like we heard earlier, I would say, maybe line of credit, credit card for some of those small purchases might be appropriate. If you're looking at a bigger project and you need significant access to capital, we do offer that, maybe some more creative ways that our business bankers could look at, but we would probably want more info about what you need.
Excellent, thank you.
All right, any other questions for Tim? All right, thank you, Tim. Appreciate it. Great presentation. All right, next up, we have Dom St. Angelo from Gallagher and Kennedy. And, this workshop is talking about growing your business. We just had Wells Fargo talk about debt and lines of credit. And Dom's going to get in and talk a little bit about for those companies that might need investment from others, whether it's venture, angel investment from your friends and family. The investment piece can get tricky, and that's why we've got the lawyers here to talk about that piece. Tom, all yours. It's forward.
All right, well, hello, everyone. Thanks for the warm introduction and the speakers so far for your wisdom too. As a lawyer, it's always good to hear from the other professionals that advise on a lot of the same issues that we do. So like they said, my name is Dominic Sangelo. I work at Gallagher and Kennedy. My practice is primarily in corporate mergers and acquisitions, securities, and kind of general business law advising. Our firm represents clients at all stages of growth. So as early as I have an idea for a business, I haven't even started yet, to we're a publicly traded company and we trade on NASDAQ or NYSE. So, and everything in between. So in terms of capital raising considerations, whether it's from friends and family round, or we're just putting together some kind of partnership through an exit, either through M&A or going public. So we're going to talk about money today. That's the topic. That's what everyone's interested in. And at least I hope you are. If you're not, then the next 30 minutes might be brutal, but feel free to sleep with your eyes open. We're going to have basically a high level overview of capital raising considerations, steps to prepare to raise capital through equity offerings. We'll talk about what the difference is. I'll share some warnings, some pitfalls, some war stories. Hopefully we'll have just the right amount of memes. If you were here last time, you might remember that I like to incorporate a lot of silliness into my presentations just to keep everybody awake and paying attention. Maybe you'll remember things a little bit better if you see some pictures. I teach a business law class at Grand Canyon University, and so I'm used to a Gen Z audience that if you don't have pictures and videos, they lose interest. So the content will be fairly similar to last time if you were here, but I did change a few things up. So hopefully it'll be slightly different. The first question really in my mind is, why are you raising capital? What are your goals? What do you need the money for? Everybody wants to have money to run their business, but if you've thought strategically about it, how will that increase capital? If you get an investor to write a big check, what are you going to do with it? Do you have a concrete plan for how you're going to use the funds? Is equity financing the right choice right now? Do you want to be talking to VCs, to PEs, private equity firms? Or is there some other way to bring capital into your business? So can you be raising capital from within? Should the first choice be, can we fund this business with personal funds of the owners? You know, there's pros and cons to doing that. Obviously, there's no dilution. We'll talk about that in terms of what percentage ownership of the business you own. There's no loss of control when you just simply contribute more of your own money, more on voting control later as well. You don't necessarily have to pay that money back at any particular time. So unlike debt financing where you have regular payments or monthly or quarterly payments you might have to make, if it's equity, you have a longer time horizon. And if you're raising money from employees or giving them an ownership stake, then maybe you're giving them some skin in the game, or there's some alignment of the incentives in terms of wanting to grow the business, not just as an employee so you can get a bigger paycheck, because maybe you have some upside as well. The cons, obviously, unless you're Elon Musk, you probably don't have basically unlimited capital to plow into your own business. You're going to be less diversified from a personal finance perspective. Even if you are Elon Musk, the more money you're putting into your business, the more eggs you have in one basket if things go wrong. And the other is that your current investors might be tapped out. So when you go to them and ask for more money, they might say, look, we've given you all the money that we're prepared to give. So that might not work. Obviously, the safest way to grow your business with capital is just bootstrapping it. So what is bootstrapping? Well, bootstrapping is reinvesting the cash flow that your business already generates. So if you're a profitable company, you're selling goods and services, you reinvest those profits into the business and you can use that as your working capital to grow. Similar pros as reinvesting your own personal funds into your business. You don't dilute yourself. You don't dilute your other business owners. And it's managed growth. It's safe. It builds confidence in the business model for future investors to look and see, oh, they've reinvested their cash and grown organically. That's great. The cons are you need to be making money to do that. So if you're an early stage company and maybe your concept stage, maybe you don't have profits to reinvest. Maybe you have a burn rate of the cash you have on hand. So there is no cash to reinvest in the business. The other con is that it's harder to do. It's much slower. If you have a plan to try to take advantage of market conditions or a gap in the market that your business could fill, and you need more capital to scale up quickly, bootstrapping might not be the way to go. Oh, oops. So one of your choices, and I think you should think about this both in terms of whether you're going to be raising equity from investors or not, is what about debt? Can we look at debt first? Should we be calling Wells Fargo or your bank or some other types of lenders to see if you can get money that way? The biggest pro here is that you don't suffer any dilution. So if you own 70% of your company and you take on some debt, well, from Wells Fargo is not an owner of your company. You still own 70%, even if you brought in more cash. So as much as a lender likes to say, well, we partner with our clients, they do in the kind of business sense, but not in the legal sense. They're not an owner. There's no loss of voting control. So in terms of the voting decisions of what kind of steps do we want to take in our company, what decisions do we want to make, the lender doesn't have a seat at the table to make those decisions, although, depending on your financing arrangement, they often include negative covenants in your loan agreements to say, you can do this, but you can't do these sorts of things without our permission. So in some ways, you do give up a little bit of control of your company with debt financing, but not to the same degree you would with equity necessarily. The other pros, you have higher potential returns if it works out. So if you don't dilute your ownership, and so if the business takes off and starts generating a lot of cash flow, then that upside is all yours. Your lender just gets their fixed interest rate return and they don't share in that upside. Obviously, the con is that if you can't pay the money back, the lender's still going to want their cash repaid and they're going to want their interest. And if the business doesn't work out at all and you have to close up shop, they're first in line to get paid. So your creditors, the lenders that you borrowed money from, they're going to get paid back first before any of the owners. It can also make raising further capital more difficult. Obviously, if you have a lot of debt on the books, potential investors are going to see that. It makes it a little bit more of a risky investment for them. So from a debt perspective, obviously pros and cons, but something to be thinking about as a first choice or even in connection with your equity finance. So if you do decide that what we want to do is go down the equity path and raise money from investors, you're going to obviously think about what the value of your company is, what is a percentage stake in your company worth. If you've watched Shark Tank, you've probably seen this play out in real life. And so you think about raising outside capital. We've tapped out our current investors. I put all the money I can into my own business. Bootstrapping isn't going to work to get us to scale fast enough. I either can't get debt financing because we don't have the assets or the cash flow to support it, or we already have our debt financing in piece in place, but we need something more. So the benefits of raising outside capital, obviously, is you don't typically have a defined payback period. So often when you're raising capital from outside investors, you tell them, hopefully you get your money back someday, but I don't know when that is. And you agree that you're in this for the long haul, and we'll see if we ever sell the company, you'll get a big payday. And until then, you're just gonna get updates from me from time to time. The other good news is that you're pari passu with the other owners, meaning if there's a bankruptcy or liquidation or you sell the company, everybody's on the same playing field. The other owners don't necessarily get paid for you. Obviously, there's some more complicated equity arrangements where people get preferred stock or whatever, where they might get paid first, but generally everybody's on the same playing field. The other pro is sometimes there's potential strategic value in having certain investors that might be in your space or open up relationships that wouldn't be available to you otherwise. So you might think about who are your investors, not just what money are they bringing, but also what relationships, what knowledge, what skills might they bring to the table. The big cons, obviously, though, here are you're going to dilute your ownership. So if you sell a piece of your business for equity, then you own a smaller percentage of your own company. You and all the other investors, unless you're investing alongside the new person, you're going to have a smaller percentage. Obviously, owning a smaller piece of a much bigger pie might mean that you have more pie overall. But something to think about in terms of your ownership position relative to your other partners. The other con is that investors sometimes negotiate for other certain rights. So maybe they get paid back first, or maybe they get a board seat. Maybe there's certain decisions that you can't make without their consent, things like that. The other is just simply they might be annoying to have. So if you have a new business partner who put in money and they want updates and they're asking you for things all the time, that could be annoying or could be difficult. And if you end up not getting along later, it's kind of like a bad relationship that you can't get out of, and you want to avoid that. So sometimes the updates can be annoying. There's also, skipping back for a second, there's other ways to raise capital. You could do franchising, for example. It's kind of beyond the scope of this presentation. You do an initial coin offering if you're into cryptocurrency. That's a kind of a new nascent industry in terms of being able to raise capital other creative ways, but we'll stick to the more traditional methods. So one of the things to think about too is, where are you in the life cycle of your business? I know this is a small business presentation. Apparently that means anywhere from 1 to, I think, 500 employees. Common sense tells you that if you're a brand new company with 2 employees, your needs and your considerations are going to be a lot different than if you've been in business for 10 years, you have 499. So are you a startup? Are you early stage? Are you established, mature? All those things factor into your capital raising strategy, or at least they should. So who are you talking to in terms of getting capital? Depending on what kind of company you are, where you're at, what your plans are, it might be friends and family. If you're a small business just starting out, this is probably the best place to start, because they're the ones that are going to have the most trust in you. Reach out to your own network, see if you can raise enough money to get started with just a friends and family round. The next phase is kind of talking to angel investors. So early investors who are willing to make an investment now with the hope that they'll get taken out at a later stage by other investors that are looking at more mature companies than what you are. At the stage where you're in that kind of next phase of growth, it might make sense to be talking to venture capital and private equity firms, family offices, other companies in your space that are larger and more established. Those have some obvious benefits in terms of scaling and building your network and receiving larger amounts of money. But they're also going to be a little more demanding, and they're typically going to want to see a little bit more progress than maybe your friends and family would. The other thing you want to make sure, and this is really key, is having all the right advisors in place. So talking to your lawyer is good, but sometimes the lawyer is not necessarily always the first place to start. And even if they are, they're going to say, well, what accounting firm are you using? Who's your internal bookkeeper? Do you have your insurance in place? Do you have a banking relationship? You know, all these things also matter in terms of the stack of advisors. So takeaway is assemble a good team around you to help advise you, because your time is best spent running your business and doing what you're good at. Let the professionals do what they're good at to help you. So one of the things, once you've decided that equity fundraising is the right choice for you, is, do you know what you want? Or is this just, you watch Silicon Valley and you think that the thing you need to do is raise money? How much do you need? What are you going to use it for? Are you going to need to raise more money soon in the future? What is the burn rate of that cash? What form of equity are you selling? So are you going to be selling stock in your company? Are you selling options to buy stock in your company? Are you issuing convertible notes? This is probably the preferred type, which is a mix of debt and equity. Basically, someone loans you money, but if they want to, they can change it into equity later. The most common thing I see with startups is they have what's called a SAFE, or simple agreement for equity. These are just promises to give equity in the future for some amount of cash investment. There's a whole array of options. And so that's really a question you should be talking to your financial advisor, your investment banker about. What is our capital stack? What are we willing to offer? What kind of valuation are we going to get if we go these different routes? The lawyers can help you with that too, but it's more of a finance question than a legal one. So make sure, going back to the dream team concept, make sure you're talking to not just your lawyer about this or your accountant about this, but also your strategic financial advisor. It's helpful to know what your company's worth. So getting an idea of the valuation, what is my company worth today? You know, if I'm talking to Mark Cuban on Shark Tank about a 10% investment, what should he be paying for that 10% investment? It's good to know that up front. What is my company going to look like if I get that money, post money after we raise the money? What is it worth now? And how much dilution are you willing to take? How much decision-making authority are you willing to give up? So there's obviously strings attached to any kind of money you get from somebody, whether it's a bank or an investor. So be thinking about that. Obviously, this is the ideal trade scenario. I get unlimited access to funds, and in return, you get no voting rights and just a very small piece of my company. Unfortunately, that's not usually how it goes. But the more ready you are to accept investment capital, the better, meaning you have all the things in place that your investors are going to want to see. So is your legal structure sound? Do you have an entity set up? Do you have all the governance documents that you're supposed to have? Articles, bylaws, or if you're a limited liability company, an operating agreement? Do you have all of these basic structures in place so that if an investor comes in, they know exactly what their rights are going to be? Is your cap table clean and clear? Are there any side deals? I see this with small companies a lot where they say, oh, I own 100% of the business, but they also gave their brother-in-law the right to buy in at 10% at any time if you give me $5,000 before I get started. And that's nowhere on the cap table. It doesn't show up anywhere, but there's an email sitting in somebody's inbox that makes this promise. You want all of those kind of arrangements, everything to be clearly reflected on your cap table. All of your contracts, what I call the material contracts. When I say material, I don't mean like materials to build things. I mean the important ones. So your leases, your key customer agreements, your key supplier agreements, are all of those in the name of the company. One of the mistakes I see quite often with small businesses is they start their business, they sign as John Smith on this contract that has to do with their business. They form their LLC. And all of a sudden, these contracts don't match up. They're not in the name of the business. From a liability perspective, that's bad. And also investors are not going to want to see that because they're going to say, well, I'm investing in this business, but is this contract even with the business or is it just with you? Has that been contributed? So all these things are going to be important. You want to clean that up and make sure you're keeping all that straight. This isn't really a legal point, but your financials, it's really important to have clear, understandable financials have been prepared by somebody that knows what they're doing. An investor, the first question they're probably going to want to see after who are you, what do you do, what's your strategy is, let me look at your balance sheet, let me look at your income statement, I want to run the numbers. So if those aren't prepared, if they're not something that investors are going to have confidence are accurate, they're not going to want to invest. Is your business plan written? Is it understandable? Is there something I can look at as an investor and flip through and see, okay, I get what their goals are. I see how my money is going to add value to their business, how it's going to get them to the next level. I see the vision of how me, the investor, is going to get rich by giving you money to make me more money. So these folks are going to want to see all that, but if you're careful, you should be sending an NDA or a non-disclosure agreement, confidentiality agreement, whatever you want to call it, to the investor before you share all these things. So if you have the secret sauce for some industry, you see an opportunity, you've developed a technology or a process or a product to address these needs, make sure that these potential investors that are going to see behind the curtain of everything you're doing can't just rip off your idea and go implement it or start their own company where they say, oh, you know, I could give you money to go do this, but I think I'll just do it myself. You want to be protected. So make sure you're always, 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 before you're sharing any secrets of the company, getting NDAs signed. And that includes if you have a pitch deck, you should have, if you're going to be out raising money, you know, friends and family, you can maybe just talk to them about your business. But when you get to that next stage of looking at institutional money, looking at strategic investors, more savvy ones, you're going to want to have a pitch deck where you tell them all the great things, all the way that everybody who puts money into this is going to get rich, and we're going to change the world, and we're going to disrupt this or that. You want to have all that in a marketing document that that sells. But be careful with the salesy stuff because there's all sorts of rules about soliciting investor capital. So if you're selling stock, if you're selling limited liability company interests, partnership interests sometimes, those are securities. So you have to disclose certain facts. There's all kinds of rules. You definitely want to talk to an attorney before you accept any investment or even offer any investment to anybody. The securities laws are very confusing. Basically, a security is an investment of money in a common enterprise with the expectation of profit from the efforts of others. So if you think about, is what I'm selling to somebody an opportunity to invest in my company in a common enterprise, me and some other people, and are they expecting to make money from their investment? And are they expecting to make money because of my efforts and the efforts of other people, and all they're doing is supplying cash? Well, now you have a security. So you've sold something that has to either be registered with the SEC or the ACC or both, or it has to fit into one of the exemptions to registration. So there's a number of different ways to do that. And we can talk about those, although, you know, I don't want to put anyone to sleep too fast, but there are ways to do it legally, and there's ways that people do it often that are not fully legal. The most common exemption is what I like to call the happy investor exemption. It's not a legal exemption, but if everybody makes money and is really happy, typically nobody gets sued, no one gets reported to the SEC. Don't rely on the happy investor exemption, particularly when we may or may not be going into a recession. Because as soon as people lose their money or the returns aren't exactly what they expected, they're going to call some other lawyer and say, hey, was this done properly? Is there anything I can do to get my money back? So if you didn't comply with all the different rules that the government puts out on issuers of securities, you could run into some trouble. Generally, the two easiest exemptions to fall under is to sell to accredited investors only. Accredited investor is code for rich people. So if you have rich people that want to give you money, the government doesn't protect rich people as much as they do not rich people. So if you have a Rolodex of a bunch of rich people that want to invest, great, that's going to be the safest way to do it. If you're trying to raise money from non-rich people, ordinary people, there's a little bit more hoops to jump through. And so you should talk to your attorney about how you can reach those people if that's what you're going to do. Also, having less than 100 investors typically is recommended because there's investment company rules about if you're offering this to a bunch of different people, do you have to register as an investment company or investment advisor? You just kind of want to avoid that. Our advice generally is try to raise your money from less than 100 people. But the biggest rule is when in doubt, disclose. So the key to not getting sued if you do a securities offering for equity, you're raising money from people, is tell them all the bad stuff. So we talked about the pitch deck that tells them all the good stuff, all the things that they're going to love about the company, about your mission, how everybody's going to get super rich. I was a marketing major in college. I get that part. That's how you sell people on investing in your company. There has to be some pizzazz. As a lawyer, my job is to throw cold water all over all the pizzazz. So I'm going to, in the fine print, tell them, here's all the different ways you can lose your money. Here's all the risks we face. Here's all the problems we have. Here's all the problems we see in the market. You want to tell them all the bad stuff so that people, when they invest in your company, if it doesn't work out and then they try to sue you and say, well, I was told I was going to get rich because I looked at the fancy pitch deck and I saw all the things that they plan to do. We can go, well, yeah, but remember on page 40, we told you that this was a big risk and that when you invest, we might go bankrupt and this might be why, and then they lose their money and tough on that. And that's the position you want to be in, is you want to lose other people's money and not have to get sued for it. Obviously, no one wants to lose money, but the reality is lots of businesses don't work out exactly how you thought. And so you don't want to be caught in a position where you didn't disclose some risks. So the key takeaways here is step one, identify why and what you need capital for. This is a theme that you heard with the debt piece. It continues in this piece of the presentation. Always be thinking strategically about uses of your cash. Decide whether outside equity fundraising is right for you. Are you at the right stage to do it? Does it make sense with your overall kind of capital stack? Is it going to help you achieve your goals? Or are you just going to be giving away a big chunk of the company that you worked so hard to build for no real clear purpose? If you are going to raise capital, make sure to get your house in order, clean up all your corporate documents, make sure you have good bookkeeping, make sure that all of your contracts are in place and everything is nice and clean to make it as easy for the investor to say, okay, I know exactly what I'm getting into. I see that they're doing a good job running their company. All those things matter a lot, and they can matter for valuation, they can matter for terms, they can matter just for how easy it is to attract investment. And then you want to assemble that team of professionals. I tell people all the time, your time is best spent focusing on running your business. I can't run your business. I don't have the skills to do what you do. And you don't have the skills to do what I do. You don't have the skills to do what your accountant does. Maybe you can figure it out, but you're not going to do it as efficiently or as well as they are. Focus on your core business, outsource to the professionals the pieces that need to be outsourced or that should be outsourced to make the best use of your time. So having a CFO or a bookkeeper or an accountant on staff or somebody that you rely on is great. If you don't have that, or it doesn't make sense for you to have that, outsource that piece. But always, always, always make sure you have financial professionals advising you. Make sure you have a tax advisor, make sure you have an insurance provider, make sure you have a good banker. And then obviously the most important piece, make sure you have a good corporate lawyer to advise you on how to stay above board and do things the right way. I tell people all the time, I'm a corporate lawyer, I do contracts, I do deals. The people down the hall from me, they sue people and defend lawsuits. It's way better to pay me a little bit of money up front than to pay my colleague down the hall hundreds of thousands of dollars for something that we could have avoided if you had just called me 6 months ago. So when you've done all that, then it's time to go pitch and go raise some money and take your business to the next level. Any questions? I went through that really fast because last time I almost ran out of time, and I wanted to make sure to leave a little bit of time in case anybody had any lingering questions. Okay, well, if not, thank you for your time and good luck.
Excellent. Thank you, Dom. That was a great presentation. Go pitch for those around. There's opportunities for business plan competitions all over the place. There's some workshops that people do where you can work on your pitch and get that down for regardless of what size of business you are. Marketing pitch is always helpful too when you're trying to sell your product or service. So with that, wrapped up, that's our contact information for Dom. And we're gonna take a 10-minute break and then we get up and stretch for a moment. So we will start back at 10:45 on the dot.
I've never really pursued this part of it, but you know, there was one proactive, sort of collateral something.
as you grow your business, you got to think about benefits. And Carrie's going to touch on another piece is the mental health of your employees as well. So we're really looking forward to this presentation. So Carrie, it's all yours.
Well, good morning, everyone. Thank you so much. I'm glad we had a break because what I'm going to be talking about is a lot different than probably what we covered this morning. My name is Carrie Stinchcomb. I am actually director of our large group service team. So when we were talking largest of the large, that would be me. But I have been in the business of what we call human capital. So if you're looking at different kinds of capital, I've been in human capital for the past 30 years. And so I've touched all sizes of businesses. I have sold to groups of 2 all the way to, we've got the state of Arizona. We've got 63,000 employees in that one. So we've got them all over the map. I have never had my own small business. So I was like floored by the amount that you all have to go through and think about, because I've thought about how fun it might be to have a small business. And now I'm kind of like, oh, that doesn't sound as fun as I thought it would be. So anyway, we're going to talk a lot about human capital. So meaning employee benefits. So when you are ready to, maybe have employees in your company, what do you need to do with your benefits? So first of all, why would you even want to offer health insurance? As we all know, it's available to everybody in America, right? Easy. Just go on to the exchange. Anybody can get a plan. Why would we want to offer it through our employers? Well, number one reason is it's competition for talent. So some ways it's table stakes now to offer employee plans. Employees also want to feel protected and secure. And some employees, it's not as much about how much they make, they want to know that they have a health benefit plan. Sometimes the cost for a group health plan will be less than what you would be paying on an individual basis. I'll get into kind of some of the options that we have. Believe it or not, wages are not the only factor that employees are looking at. And what's interesting, what we're starting to find out is some of these Gen Z, they're actually kind of returning to wanting more security. They've been through, a lot of them came of age at a time when we were going through our first recession. They know what is coming against them now too. So they look at benefits very differently than maybe, people in my generation, Generation X would. Also, healthy employees are more productive, okay? So that's one of the things too. If they feel secure and they are healthy, they're going to be more productive employees. So that's one of the other reasons that you may want to think about offering health insurance. So one of the things that you kind of think about as a small business is, I don't have more than 50 employees. I don't have to offer this. I'm just going to do my own individual. Everybody else can get their own individual. But please know that if you have more than one common law employee, you are eligible to look at group health insurance. So what kinds of plans are out there? We kind of put them into like 3 different parts. So the first kinds of plans are what you're going to think about is like your traditional kind of plan. That would be, we call them the ACA fully insured metal plans. These are Obamacare regulated plans. So if you remember when Obamacare came out, was it 2000, whatever. It came out a while ago. It feels like it's been here forever, but it hasn't. These are very regulated plans. The government says what the out-of-pocket maxes can be on those. They are given a gold, a silver, a platinum. They're given a different kind of level of what those plans are. They're also regulated on how the rating models can work on them and what premiums can be charged. And as an insurance company, if you want to participate in these plans, you have to offer the same rate to everybody. Okay. And you have to, if you want to change your rate, you've got to refile new rates. right? But they're really easy to figure out how much they are, right? Because they're online. You can go there and find them out yourself. You don't need to do a whole lot. Then we get into kind of some nuances of that. So we get into association health plan. Blue Cross Blue Shield has actually contracted and developed some association plans working with different kinds of businesses. So we've got an association for construction, automotive, manufacturing. We have an association plan with the Arizona Tech Council. We even have a professional employee organization, which is called a PEO through CBR, where we offer plans through those, okay? The thing about these plans is that they're not as regulated by the Obamacare, okay? So these plans we can do a little bit more, underwriting on them. So they could be less expensive because we're able to pool the experience based on these industries that's in these plans. But they're not guaranteed issue necessarily. So you could be, you're not necessarily gonna be able to have those plans. What's become very attractive and new, especially for small businesses that never thought they could participate in these, is what we call partially self-funded plans. So fully insured plans, that means you're paying a premium every month. If you have no claims for the whole year, the insurance company has a big windfall on you and you're helping offset everybody else's, losses, right? So it's kind of like your car insurance. Like if you had no accidents, you're not, you drew nothing on it, but you're still paid your premiums. When you go self-funded, you kind of are paying only when you have claims, right? Now, if you're a small enough company, there's a lot of ways we have to package these together because you couldn't, obviously as a small business, you cannot afford $1 million claim, right? You need the protection of insurance. So we're able to put these kinds of plans together that actually almost look like a fully insured premium every month, but you can kind of benefit from the fact that you've got the cash flow of self-funding as well. It gets a little complicated. We have many insurance brokers out there, and I heard get your insurance in line. So hopefully when you're ready to be getting into group plans, you can talk to an insurance broker. You don't actually have to pay for insurance brokers. We'll, kind of include it in everything that we are doing and administering with the plans. You can also talk to people directly at Blue Cross. So we will work with small businesses directly on their needs as well. So let's talk about two kinds of medical health plans. So we've got traditional copay plans. We all should know these. These are your PPO plans, right? You pay copays when you go to doctors, urgent care. Most things are not subject to deductible unless you go to have like inpatient services, some like high dollar radiology, an outpatient surgery. And the member cost share applies to both their out-of-pocket max and meeting your deductible. Okay, so that's one kind of plan. The second kind of plan is consumer-driven high deductible health plans. And these are typically paired with a health savings account. So you'll hear a lot of people, unfortunately, we have changed the name of these plans to HSA plans. But really the HSA is the banking to help you with the financing of these plans. The actual plan is a high deductible health plan. And what that means in a high deductible health plan is that you first have to meet your deductible for everything. Okay, so you don't have those copays anymore. And then you go into the plan actually covering some of your expenses, but you commonly put those with a health savings plan. This is really popular with business owners. Okay, business owners really like the tax sheltering of these. My dad was in insurance as well, just like me. And he retired in 1996. And he was on Aetna's retiree benefits. And I remember one Thanksgiving, they'd come out with the new plans for January. And one of the offerings in probably 2007 or 8 was a high deductible health plan with this HSA. So I had to sit down this, 55-year-old man and try to explain this new HSA concept to him. And he's a smart guy, but he was out of the business. So he didn't know what I knew in the last 3 years that it happened. And I tried to explain it, he just didn't get it and all of that. And I finally like left, and he calls me back 3 days later and says, oh my God, I get it. How do I not do this? This is such a great deal. Because it's the only financing vehicle out there that's triple tax deductible. So when you put contributions into your health savings account, you're not taxed on them. They earn interest. You don't have tax on the interest. If you invest the money, you're not taxed on any of the investment. And when you spend it, as long as it's on qualified health expenses, you're not taxed on it. So my dad comes back and says, how many martinis did Congress have before they passed this thing? Because this is something we all should be taking advantage of. And it also is, you can use these plans not only to pay for, your deductible or your co-pays. Later on, you can use it for long-term care premiums. You can do other things later in life too. So it can also be a retirement kind of savings vehicle as well. And a lot of people use these plans too in lieu of having an HSA or an FSA, excuse me. Those are those flex spending accounts that we had for like dental and vision and those things. So you can also use this. And there's not all the receipts, and you don't have to keep all as much track of things and all of that. So HSAs are great. I've been participating in one since they came out in 2005. So I don't even want to like make you all feel bad about how much money I've saved in it, but it's a lot. So networks. One of the things that's gotten really popular in Arizona is that we're able to offer a 10 to 15% lower price point if you're willing to go to a smaller network of providers. So we call it our Alliance Network here in Maricopa County, and we have Pima Connect in Tucson. So you have a smaller amount of providers. So up here it's Banner and Honor Health and some of their affiliated providers. Or we also have our broad network, which is pretty much everybody in the state of Arizona, 98% of the hospitals and 96% of the physicians. So there's kind of two options, but we're seeing a lot of interest right now in going to these narrow networks. And Blue Cross is not the only one that has narrow networks. We have narrow networks with our competitors as well, but this is very, very popular right now. In addition to looking at medical, I always suggest you look at other benefits as well. It's amazing to me how much people care about dental. They really want a dental plan. A lot of people want a vision plan. EAP, that's employee assistance programs. These are very, very inexpensive that can be added to your plans, and they're going to address some of the mental health issues. Critical illness accident plans. Those are like, a lot of people know like the AFLAC plans. Well, we all sell those, so we have those plans as well. So you want to round out your portfolio of plans. So how do I get in on this? What do I have to do and how much do I have to pay? For a group health plan, you have to have at least 70% of your employees participating. You've got to pay at least 50% of the employee-only premium. So you're going to get a premium that says, it's $700 for employee, it's $1,400 for employee plus spouse. Well, you've got to at least pay $350 of that $750 per month. You can't discriminate. You can't decide, well, I only want this, my brother and his wife and family that work for me, but not the other guy that works for me for 40 hours a week. He has to at least be included in the calculation. Also keep in mind, there are laws with COBRA and mini COBRA. I'm probably too far removed from small group to know exactly. All of my large groups are subject to COBRA. So you always want to make sure and think about those things as well. Okay, I'm going to pivot a little bit to some new stuff that wasn't covered the last time and talk a little about mental health and why this is kind of important right now. One of the things that we noticed in 2020 as we were especially looking at our largest groups is there was this huge spike in mental health claims. And it was like off the charts. And we then noticed we don't have enough mental health providers to even go around to even take care of all these people. And this was a staggering statistic to me. 1 in 5 adults lives with a mental illness. And I thought, that's crazy to me. That's a lot of people. And then I kind of thought back to myself even in 2020, March. Nothing in my life got bad. I mean, I had to work from home, but my paycheck didn't change, nothing changed. And I finally realized what did change is I had a daughter who's a junior in high school. She had this great life going, golfing, she was a star golfer. She had just got this new boyfriend. He was on the baseball team. They were planning for prom. Everything was going great. And then spring break hit. She didn't get to go back to school. She stopped even having to do school because they said, take your grades before you went. They started canceling all her golf tournaments. Her boyfriend broke up with her because he couldn't handle it. His graduation got canceled. You're only as happy as your most unhappy kid, right? And it was tough. It was tough. And she got to a point where she's like, I don't even want to look forward to anything because they're canceling everything. So that's the kind of stuff that's draining on people. And that's not mental illness, but that was depression. That was things that we were dealing with in our own family. And I really wasn't dealing with much. So I can't even imagine if you were dealing with a whole bunch of other things. So one of the things that we've done at Blue Cross is we've actually put together what we call mental health first aid. So think of it as like CPR. We all go through CPR training. Well, we've put together this mental health first aid training. And what we're doing is we're training people on how to identify suicide tendencies, depression. How do you get people to resources? And we're offering this to our customers. And it's you do a 2-hour course, and we're doing an online. We can do it in person too, but we're finding this online is working really well. So you do 2 hours in advance, and then about 6.5 hours course led with a trainer. I actually went through it myself. Very, very good. We've gotten some great feedback on it. And what's really great about it is the cost that we're able to do it for. So we're actually offering it like $23.95 per participant. So it's been really a reasonable cost. Blue Cross in general, we're really fortunate. We are the only nonprofit health insurance company in Arizona. And what I love about working at Blue Cross is that when we do make profits, we get to reinvest them back into Arizona. And in 2021, we actually, instead of like investing directly from the company, we actually formed a foundation. And we're tackling 4 different areas in this year: substance abuse disorder, mental health, chronic condition, and health equity. So 2 of our 4 are in the mental health field. I'm also really proud of some of the work that we did as far as, I don't know if anyone saw us doing the State Farm. We were leading all of the volunteers for vaccinations. I was out there once a week leading a charge every day. We also were big into giving money, and we really were trying to support a lot of small businesses. We had a lot of time back then too, where we extended everyone's cash flow on ability to pay premiums and things like that as well. So we tried to work with all of our customers that way. And in mental health in particular, we're really, really focused. We have earmarked $5 million for the next 3 years that we're going to reinvest back into the community for mental health endeavors, including $2 million just this year alone. So mental health is something that if you're not thinking about it, definitely think about it, especially as you get more employees. One of the stats I heard, one of your key performance metrics was employee retention. And I'd say that is probably a #1 key performance metric that all of my largest customers are looking at. And it's really through benefits and focusing on the things like mental health that you can actually have the most productive employees and keep them for the long haul. That's it. That's all I had. I don't know how long it took me to do it. Let me know what other questions.
All right, do you have any questions in here or online? Right.
What's this?
Yep. Should be green.
Okay, my question is, well, I need 2 terms defined. You started out with common law employee. What's that? What do you mean by that term? Common law employee.
Yeah, it was one of the first.
That was what you started with?
Yeah.
when you First started
So
out?
it could be, they have to technically be an employee. You have to pay them a salary. They can't just be necessarily your spouse. You know, you're a single owner and you just have a spouse, but they don't actually get a salary and they don't actually, all of that. They're not an employee.
Okay,
But if they actually are an employee, then they can be a part of the group.
Okay.
The best thing to do is to actually talk to your insurance broker or to talk to somebody that's a much better expert than myself at small business.
okay.
I sold small group back when we used to have a 400% rate up based on medical questionnaires. So things are a lot different. So I know the rules have changed quite a bit and everybody's gotten a little more flexible. Yeah.
Sole proprietors where, it's just you and then maybe your spouse and your family, that falls into the individual category.
Okay. So you have to have somebody that's not actually on your own tax returns. Is that
Okay.
probably,
Okay.
yeah,
And the second one on the ACA slide,
yes.
you had the word metal on there. Should that have been metal?
What we do, the metal plans, we call them metal because that's what the Obamacare calls them. So when Obamacare, you put through the plan, through this like algorithm, and it'll say, based on how much out of pocket there are and the co-pays and how much all of this is a gold plan. This one's a silver plan. That way it helps the consumer better be able to compare and contrast the different plans. So, and I'd say majority of the plans fall into silver, believe it or not. And then there's a few golds and sometimes one or two platinums, but most plans are silver. Bronze is your lowest level. So it goes bronze, silver, gold, platinum.
Okay.
But most plans fall into silver. And then the ACA plans is also where people can, if you go on, they kind of match up with the individual market as well. So, when you go in to like apply as an individual, they also have the metal as well. So it kind of helps you compare and contrast maybe the same kind of plan between the group versus an individual. And the individual market is where people can get, if they qualify for the subsidies.
And real quick on this slide, the ACA is the Affordable Care Act.
Yes, sorry.
Not
Yes,
the Arizona
Affordable
Commerce
Care
Authority.
Act.
We do not have a plan for everybody. It's the
We
Affordable
always,
Care Act.
we're very bad at acronyms. The ACA, the ACA, the Affordable Care Act plans, metal plans.
Any other questions? We have one online.
We have one question online. The question reads how they can check to see who is in the Blue Cross Blue Shield network and specifically asking if Mayo Clinic is in the network.
Mayo is not in for small group. Okay. Let's see. Networks, I was at there. Definitely want to look at the network when you're deciding which plan. www.azblue.com. You can find our directory for sure there. And Mayo is in, we don't have it in our small group, the ACA metal plans, but we do have, that is a network provider in our larger group plans.
Excellent.
Partly, let me just kind of say why the Mayo price point, we're trying to keep those plans as affordable as possible. So it's possible at some point in time we may add it, but right now it is not.
Excellent. We have a second question from online. If you don't have a company health insurance group plan, can you still have an HSA in the business?
Absolutely. So if you buy your own high deductible health plan, right? So you go to the marketplace and if it's qualified, they call them HSA qualified plan. So you have to have a certain amount of deductible. I think it's close to $3,000 minimum deductible now. As long as you have that, then you can go to a bank. Wells Fargo probably sells health savings account plans and you can buy your own health savings account plan. Or you could have a plan from another employer where you still have that health savings account. You can put the money in yourself into that health savings account plan. Most employers are doing it for you because it's really easy. Then you can do it through payroll deductions and all of that. But you know, I would always encourage you, if you're not looking at a house savings account, definitely think about doing that. It's a great little tax advantage thing.
Excellent, thank you.
All right, don't see any other questions. Thank you, Carrie.
Thank you.
All right. Next up, we've got our friends from the SBDC. We've got CJ Johnson. He's going to share some information, and the Small Business Development Center is, oh, we gotta get the right slide. All right, so the Small Business Development Center is a program, and she'll talk in more detail about their program, but I work closely with them all over the state. They do business counseling, and one reason why they're here and they're going to talk about is a program that they have to help businesses access funding. So CJ, it's all yours.
Good morning. It's almost lunchtime already. Excited. Good morning. My name is CJ Johnson. I am I'm going to get to the first one. Is that forward? Yes, there we are. I'm a funding outreach specialist with the Arizona SBDC. We are a statewide resource that partners with SBA, and we are a partner with the ACA as well. Right now, we have 10 different centers that are here in Arizona throughout. They are within all the different communities, rural and metropolitan as well. They are structured on and hosted by different community colleges. So here in the county of Maricopa, we have 10 locations just in this county alone that we work out of. And then our other 9 centers are also off of local community colleges. The centers throughout the state, when they're hosted by the colleges and we're on site, that's the way it was. Now we're hybrid. We're working off-site at home offices, and then we're starting to filter back into those offices a little bit. So we've been doing a lot of Zoom meetings, and actually we found that that is really useful for business owners because it takes out the travel time, it's convenient, it's more strategic. We do trainings right online as we're speaking with business owners. And what this comes out to is the economic impact that we have within the communities. The SBDC, we create a positive impact because we produce stronger businesses with best business practices. We help reduce the risk that lenders are looking towards when they are looking at financials and everything. We're supporting our clients in how they operate their business, find those gaps. We work with startups. So if you're brand new and kind of just filling the waters and not real sure where you want to go, we help from that point to really well-established businesses as well. Here you can see what some of our economic impact was for the past 2021. And to the right, there's some services, and I know it's a little blurry, but I'll send Bob the brochure that this actually comes out of, so you can get a copy of that as well. So over to the right, state of Arizona, there's a dozen plus business owners there. And what they all have in common is that they were all part of our 2022 Success Awards. These are different businesses that have made remarkable growth in revenue and employee growth. Some of them expanded to more locations and all that. This young lady, Lisa Odell, she was our MC at the Success Awards, and she actually graduated from the SBDC. When I first heard that, I go, who graduates? It's crazy. Well, the SBA actually decides that for us, because when a client, depending on the industry that they're in, by the SBA's determination, by their revenue, by their amount of employees that they have. If they exceed that ceiling for 3 years, then they can't use our services anymore. And that's what happened with Lisa. She started her business in 2004, and by 2015, she had exceeded the revenue of 41 million plus per year in annual revenue for 3 years. And so in 2018, she graduated from us. So she can't use our services anymore, but we're here for everybody. So that's like a really good success story I wanted to share with you. Here, it's how we want to help your business grow. We have this different program that Bob just mentioned a moment ago. It's Grow Your Small Business. It's a rollout that we started in February. It's coupled with a few facets about startups and about growing and about a B2B marketplace that we'll touch on in a little bit. But the SBDCs, when we're working with our clients, we're looking at all the different facets. We're offering training and different resources that'll help you make your goals. We look at your financials. If you're a startup, we help you build financials and look at projections. Our different resources that we offer, and you'll see it in a later slide, are lots of different tools, business plan writing tools, projection and financial predictors. We have market assessment type tools. The other thing that we do is that we help build the market strategies. So if you are looking towards a specific target market for your industry and you want a part of that market share, we have resources to help you do that research and get those numbers that you're going to need. There's been times where we're taking the information in from a client. They have a really great idea, they want to work with it, and we start doing the math. And as we're massaging it, they're sitting there going, this isn't going to work, and it's not penciling out. Thank you. You just saved me a lot of time and a lot of money of throwing it in, because on the flip side, I've had clients come in, oh, I've already signed on a contract for a lease. I got my place where I'm going to put my business. They haven't gotten an EIN. They haven't even established an entity yet. They've really put the cart in front of the horse. So our goal with the SBDC is to make sure that people understand what the proper process of starting a business is and making sure those pieces are in place. Every one of the speakers here said exactly the same thing, and it's get your team in place. Have your accountants, have your attorney, have that banker. And one of the things I didn't mention, but was on the slide, is that I came from 30 years of banking, but 20 years of commercial lending. And I've been with the SBDC about a little over 3 years now. And I used the SBDC religiously as a commercial lender because they always got my clients in order so that they could come back to me with a really complete loan package, and I would be able to approve loan packages more readily that way. So the SBDC helps gather that package, gather that information, helps you work towards your goals. You set your goals. We don't set your goals for you. We just guide you through and help you get lender ready. So it kind of takes the stress out of the process, because honestly, as a business owner, you don't go and get loans for your business every single day. It's not a common thing. So it's very foreign. So we help take the foreign portion out of it and make it a little more comfortable for you. This is our growth program that we're doing right now. Small business growth. It's a website. You can see down in the lower portion of it. What these 3 buttons do when you're on the website, and I like to call them doors. And door number 1 is starts, and that's if you're just getting out the door and you're just trying to get it beginning to really you may have formed an LLC, but you're not understanding how to do the taxes, or maybe you don't have the business plan completed, or any of those type of things. That would be the door you would choose. And once you go through there, you just sort of met with a few questions about your contact information so that we can get you started. The grow feature is for established businesses that are ready to take on some capital, and they have their P&Ls, balance sheets. They kind of have the starts of a business plan. Maybe they're weak on the financial side and they need some more help. We can help with that too. And no, we're not accountants. No, we're not attorneys. No, but we have resources and we refer out and we give you 2 or 3 names. It's up to you whether or not you like those names, but we'll help guide you through those things. And then with the match one, that's ARROW. And ARROW stands for Advancing Entrepreneurs Ready for Opportunities. So this all came about, thank you to a nice grant from Wells Fargo. And so with ARROW, when you go into ARROW, the best part I like about this all is that it's a win-win. And people say that one casually a lot, but I really truly mean it. If you're a service seeker, and what that means, you're a business owner and you're busy doing your business, but you got a website that's really not generating much revenue. Maybe your marketing's kind of and you don't have an idea what to do with social media. You can go into ARROW and you can put in a project, say, please, somebody build me a website. Somebody help me with social media. Somebody help me with these things. You put it in there. And then on the flip side, you're an established business that does those type of things. You're a provider. The provider would click on the other side and they would be matched up within this B2B business place. The awesome thing, service seekers, doesn't cost you anything. We don't charge. In fact, the SBDC, we don't charge for any of our one-on-one counseling and resources. And the reason why we don't do that is because we're partially funded by the federal government through SBA. So you've all paid for us by your tax dollars already. So you might as well use us. And then as a service provider, when you get signed up for our services, because that is the one caveat to be in ARROW, is that you need to be an SBDC client, which is a great thing because you have your counselor and your advisor working with you. And you will also have the ARROW representative helping you walk through putting your projects in or applying to fulfill a project. And the service provider, they actually get paid a stipend up to $1,200 for completing a project, depending on what it is and how many hours it has incurred. That stipend, again, is part of the Wells Fargo grant. So yay, Wells Fargo. So this is what I mean when I say it's a win-win. And this is this big program that we've been promoting since, I think, February. And then we've been pushing out. So if you haven't heard of it yet, you've heard it now. And so we can get more information on that. What's the other thing? Let's go on to this next. All right. The counseling experience, when you become an SBDC client, it's pretty straightforward. You'll have your initial counseling session. That's where you're going to get to tell them all your goals, what your ideas, you know, how much money you want to make per year, the reason why this is such a passion to you, all these type of things. They will take all this information and they're going to start working with you on setting little milestones and the steps to get to those milestones. Having that one-on-one counseling on a regular basis is critical. It is one of the team efforts, you know, along with your bankers, your attorneys, your CPAs, and having a good advisor, because they'll sit down and answer questions. And the people that work, I can speak locally here in Maricopa, come from a lot of different business backgrounds. They're business owners themselves. Some are actively business owners and doing this part-time. So they have a lot of experience behind their belts on how to run their businesses and how the things they ran into, things that were, pain points in their businesses. And I really like what Dominic said about, they like doing their business and let them do that, but have the other people, outsourced, to help with the accounting piece of it. You don't have to be an accountant to run your business, but I will personally, when I teach my other classes on financial literacy, I expect my business owners to at least understand the generalistic portions of the P&L, the balance sheet, understand what their bottom line is. And we offer classes on those two to help give you more information and understand it even deeper. All right, the tools for growth. This is only just a splattering of them, okay? Because we have so much more out there and we're getting more. Some of you lenders have definitely probably heard of Vertical IQ. It's a resource that gives you a lot of market data and information. It actually can break it down not only from state level to city to county and tell you what your industry is doing, how well it's doing. I've had individuals come to me saying, this is what I want to do. I want this, but I kind of want to do this too. And we'll look at the industries and see what the forecast is for those industries. How well are they doing? And when they look at one or the other, they're going, we'll go this way. And it helps determine a lot of things that way. I've had clients where they are considering a new location and they're thinking about somewhere in Tempe and some corner block, whatever. We have the resources to be able to pull up the data and the drive times and the demographics in that area and tell them more about that area and see, is that your target market? No, it's not. Maybe you don't want to get commercial real estate there. So at the SBDC, I work at the state office and I support all 10 centers. And no matter what the kind of capital you're seeking, whether it's lines of credit or whether it's commercial real estate or credit cards, whatever it is, I look at the whole package and I try to look at it from lender's eyes. I always walk into the office and say, okay, banker hat on us now. And that helps, streamline that process too and get those packages ready for the lender when it's time. But I don't let people off my desk until, no, these things are in line. This will increase the chances of a yes over a no. And then I go out and I actually vet lenders. I'll speak to them and say, I have a deal. This is the industry. This is what they're looking at. These are the positives. These are the cons. Is it something that you would like to look into more so? Yes or no? Yes, they do. Great. I connect them with the client and I'll give the client 2 or 3 choices of different lenders. So it streamlines them having to search and knock on a lot of doors, trying to find out when, as I know, when a deal can be done and when there's certain things that just can't. Sometimes it's like, that's definitely a CDFI deal. That is not going to go to Wells Fargo this time, but this one, this will fit. And it's all about taking care of the client, making sure that, they're met with the best chance of getting a yes, absolutely. Let's see. So these are the different tools that we have. They're all over the board and we have those, but in order to have access to them, guess what? Got to be an SBDC client. So, and with that, I will take any questions.
All right, questions do you have for CJ?
Okay.
So of all the resources that your office offers, what do you think is the most underutilized one? If you had to pick one that you think is really great and not enough people are using it, what would it be?
It would be the SBDC.net. It is a outsource research facility. They have resources that will talk about trades, patents. They will talk about target and doing the circle demographics. With them, we just have to plug in what we're looking for, and they will give us so much data, it'll make you just head spin. They point you to corporate law attorneys that are in your area. So no matter where you are in the state of Arizona, they'll pull it up. They'll give you lots of choices, lots of resources to reach out for that, but that would probably be the one that is underused.
I would also mention one of the underutilized programs is actually the SBDC.
Yes.
They offer so many things that I highly recommend. I encourage everyone that I talk to with a small business to sign up and visit with them. And it might be just once a month or once every other month or once a quarter. But I use as an example, they're a no-cost business counseling program. So if you like to go to the gym, and you could go to the gym and get a personal trainer for free every time you went, and it was the same person, you'd probably go more often. And you'd probably take advantage of that free option, that no-cost option. And so the SBDC is the same way for your business. Most, if you look at the large corporations that are out there, every CEO has mentors, they have coaches that they work with as a CEO. And as a CEO of a small business, they can be that mentor, that coach that you can work with, until you reach the success story and grow out of it. Their goal is to help you not be their client anymore by growing too much.
Yep.
So I encourage everybody to reach out and connect with either CJ or the state office, or if you're in the rural areas, every county is covered by the SBDC. And there's a center at every community college. So I can get you personally connected if you need to as well. So
we have over 1,000 in the United States. 1,000. We've been around for 40 years. Congress passed that way back then. In Arizona, it's over 30 years. Maybe it's 35 now. Losing track, but it's been a long time. We've been around forever. All right. Thank you.
thank you, CJ. All righty, now you gotta listen to me for a little bit. So this last little piece we're gonna cover, Angie Valenzuela from our team is managing this program, and she couldn't make it today. She wasn't feeling 100%, so she got me the slide deck to cover for her. And the program's called the SSBCI. How many have heard of the SSBCI? There's a few people that have. A lot of people don't know what it is. Like, what's that acronym? The acronym stands for State Small Business Credit Initiative. And so the American Rescue Plan in 2021 reauthorized the SSBCI. And so the SSBCI was actually the round one, the 1.0 version was back in about 2010, 2009, 2010, somewhere around there. Right there, 2010. And it was a credit program to help support small businesses coming out of the recession, because we know they were seriously impacted. And so this version is kind of 2.0. And it is a federal program administered by the Department of the Treasury. So, and you see the last little comment down there, a new acronym from the feds is SETI, which is socially and economically disadvantaged individuals own businesses. So that's a big focus of this program as well. That includes veteran businesses, rural businesses fall in there, urban businesses can as well. So there's a pretty broad range, and we're really excited about what our state is going to do. So with this program, it's a grant from the federal government to every state. There was amounts allotted for every state, and then the state had to apply to the Treasury to get that funding, and with their plan. And so Arizona applied for their portion. You can see it's $111 million. It's not allocated in one shot. It's over 3 tranches. So you have to use the money to get the next piece of the funds. But we submitted our plan, Arizona Commerce Authority did, to the Treasury, and with 3 parts. co-invest program for ventures, a multi-fund venture program, and then a loan guarantee program. So the AZ Venture Co-Invest is designed to make equity investments alongside institutional venture capital firms, established angel investors, corporate VCs, and other accelerators and incubators. And the multi-venture fund or the multi-fund venture is designed to make equity investments in established venture capital firms to attract new capital to Arizona. And so this is to help bring in more money from venture capitalists and angel investors into Arizona and invest in those companies along with the funding from this program. And we're real excited to see that going forward. That program is going to be run through a new nonprofit called the Arizona Venture Development Corporation. So the next piece that, you know, I won't run this directly. Again, Angie will run that, but it will be involved in working with a number of the lenders on this, is the loan guarantee program. And it's going to be working, and this is being finalized, as you say, currently being developed. So we don't have all the details, but we're going to be working with 4 to 5 community development finance institutions, CDFIs, as Tim had mentioned them. And it's going to have a focus to help potential borrowers select the lender that best meets their needs. And it's going to help guarantee some of the loan against default so the lenders can do a little bit more. So this slide shows some of those pieces, you know, effectively encourage lenders to ease some of their lending requirements. Emphasis given to small businesses and business enterprises owned and controlled by the socially and economically disadvantaged individuals. Put more capital into the hands of small business owners, eliminate some of financial institutions' risks of systemic defaults, and provide small businesses that would typically not qualify for a loan a path to increase their credit worthiness. So with that, there's some technical assistance pieces that will go to that last bit that's still being worked out. This is about all we have for now on this program, but it is coming. We're finalizing those agreements now, so we couldn't talk more about them. But this is definitely going to help small businesses on the lending side, on the debt side, as we move forward as they look to start and grow their businesses. So this is questions for overall for any of our presenters. I can try to answer a few questions on SSBCI if you have them from the bit of information I have, but that kind of wraps up. So again, questions for any of the presenters, any of the topics from today, please post them in the chat, or if you're just raise your hand.
My question is on the SSBCI.
Yeah.
How do we get on the list to know when it's ready?
So if you send me your email, I'll send it over to Angie and she'll put on email list. So when information goes out, when the loan guarantee program is finalized, that information will get sent out in the group email. Good question. Anything else? Yes.
From the very beginning, you said there are 500,000 small businesses in Arizona. Can you share the top 1 to 5 industries that those 500,000 fall into?
The top industries are single-owned small businesses. A lot of people start their own little business, solopreneur. They might be making a little bit. They're significant number home-based, just solopreneurs for whatever they're doing out of their home. You get to about 100,000 of, you can almost say, real small businesses that they're actively engaged in being a business. But on the numbers, I mean, we're seeing from the Census Bureau data that we get about 8,000 to 11,000 businesses started a month. Doesn't include the ones that leave and stop operating, but there's a lot of small businesses getting started. People have ideas. Hey, I'm going to start this business. I'm going to do this and try to do it legit. And it might be making just a little bit of money for them, but you know, selling a few cans of salsa here and there can add up. I talked to a small business owner that was making salsa and selling it so she could help put her kid through club soccer. And then she was at one of our pitch competitions I was at this last year and looking at to be able to scale it and make it a more serious business, because I'll tell you, she brought some samples, that were very good. So I would buy it. But, good question. Any other questions? All right, well, I have no problem wrapping up a few minutes early. They already gained 15 minutes back to their day. We appreciate everybody being here with us. This is the third of 4 that we're doing this year. The next one will be November 2nd. They will be in person and hybrid as well. I know Ray had mentioned when we kicked off that he'll be doing the same program for the in-person attendees there with the 75 words in the business journal. And we're gonna have a whole set of new content in the next one as well, because it's November 2nd. There's a lot of things that happen in the holidays at the end of the year and at the beginning of the year. And so we're gonna touch on that, on what you need to look at as a small business owner and with our partners on how they can help end the year and start the year strong. So with that, we'll go ahead and wrap up. And if you have any questions that we didn't answer, feel free to reach out to me via email. So we have one over here. Who should we contact with your business card? So for those in attendance, get your business card to right back here, Christina, and she will get that information so you can get that piece of the journal. So very good question. And with that, we will go ahead and close up. Thank you and have a great day.